we can probably start with a introduction. So this is again one of my favorite topics: investments in litigation funding space. Doesn't stop to amaze me how much interest is there from completely different market participants, from multi-strategy funds, private equity funds, real estate funds. So a lot of what we do now at Rudnick is work with those multi-strategy funds who are looking to enter litigation funding space, find partners, find co-funders, do equity, investment or credit lines. So I think it's a very interesting topic, and we have a great panel here, so I'll let you introduce yourself.
Hello, I'm Nicholas Marler. I'm Head of Technical Underwriting at Litica. Litica is an after-the-event legal expenses and contingent risk insurer. We are a managing general agent which holds the pen on behalf of various Lloyds and company markets.
I'm Jiamie Marshall. Litica are one of our co-insurers of Winward, which you won't have heard of because it only started last week, but you will have heard of Omni, where I was before, and I was previously Chief Investment Officer of Innsworth many years ago, and I'll know a few of you from there.
Hi, I'm Rebecca Dixon, and I'm a Managing Director at King Street Capital Management. We're a multi-strat investor with around about 25 billion AUM. So we invest across different asset classes, and one of them is litigation funding.
My name is John Kull. I'm a portfolio manager at Omni Bridgeway, responsible for the UK, as well as on the capital markets team, doing fundraising.
Hi, my name is Jiamie Chen. I'm a vice president at DE Shaw. We are a multi-strategy hedge fund. I'm sure you can Google us and read all about us on Wikipedia, but we do a whole variety of investment activities. Litigation investing is one of them.
Thank you. So, Rebecca, Jiamie, open question. So, what attracts multi-strategy funds like yourself to litigation funding as an asset class, comparing to other assets?
Go ahead. Yeah, happy to go. So, look, I think for us as a multi-strat investor, we invest across different asset classes, and one of the attractions around litigation funding is that it's a uncorrelated return to the broader market. Which creates diversity for our portfolios and diversity for our investors. So from a King Street perspective, we invest in single claims, portfolio claims, litigation, arbitration, and then global in nature as well. What we like is generally scalable investments or larger tickets, and opportunity set that is, broadly speaking, complex. It allows us just to deploy and diversify the risk that we have elsewhere. I'd say some of the things that we challenges that we see when investing in this space, and I think probably similar for a lot of people in this room, is around duration risk. It's not necessarily a negative. Sometimes having a longer term investment is a positive. It just requires more active management and typically can cause more problems if funds have closed-ended funds or less flexible capital. So as in any asset class, there's pros and cons. But overall, we very much like the uncorrelated nature of the return and the opportunity set it provides.
Yeah, and to echo some of what Rebecca just said, that's right? If you have a hedge fund or some other investment manager and one of the goals is to be market neutral across the entire hedge fund, it could be attractive for obvious reasons to have an asset class that is inherently in and of itself market uncorrelated. And at DE Shaw we have a wide variety of investment activities, and I think duration risk, while we are not set up in exactly the same way as some of our friends in this space who are pure play funders and they're operating under the constraints of a closed-ended private equity fund and so forth, duration risk for us is still an important thing that we consider as a data point in generally most, if not all, of our investments. And I think if you look at sort of hedge fund activity and some of the other strategies that hedge funds may trade in, holding a position for seconds, minutes, maybe weeks is considered a pretty long time. And I think in this asset class, we're operating in a different type of timing duration, a little bit less liquid. So that is absolutely, as Rebecca said, an important consideration.
Thank you. And just to sort of push a little on this, so obviously uncorrelated nature of the class, Anything else, returns or nature of the business? And also, I'm also interested in deals you looked at that didn't work, because I think sometimes we can learn more from the deals that funds decided not to invest and why they decided not to invest. So obviously you identified duration risk. Any other factors there where you looked and said no?
Well, I mean, when we look at opportunities that come across our desk, we look at each opportunity sort of, individually. There's not sort of categorically things that we like more than others. It's essentially, look, is this good risk or is this not good risk, right? Like if it's good risk, then we kind of delve into the next step of diligence, like, okay, so what does the legal risk profile look like? What does the counterparty risk profile look like? Is there a collection risk? All sorts of a very comprehensive sort of 360-degree perspective on things. And as you all know, we generally, and I think this would be true across all of us, we generally pass on the vast majority of things that come across our desk. It's not uncommon for deals to break for any one or more of the reasons I just said. And I think an important consideration also that's perhaps less easy to categorize would be alignment, right? You sort of have to look at what point during the lifetime of this investment could it be such that our interests, the interests of the law firm, the interests of the parties, or any other interested stakeholders could become misaligned. And maybe that's not necessarily a legal risk, but that's also another reason for deals to break all the time.
Yeah, no, I'd completely echo what Jiamie says. I think every situation is different, and as a result, we see a lot of flow. But our, conviction rate and hit rate will always be low as a result, and that's partly just because we will always intend to be selective and pick the risk that we think fits our portfolio at that time or that we need to take. As Jiamie says, it's always case by case. It's around the risk that we see and how we look at that. We typically say that we like scalable situations, meaning that if we've invested in one area and then we can add to that risk by doing kind of comparative underwrites, that's always got a big plus side for us just from a cost benefit. But yeah, I'd say each time it's on a case by case basis, and the complexity will kind of play its way out with the legal underwrite, and then ultimately what we see is the monetization strategy and how long, going back to duration, that will take to play through.
Thank you. Nick, we asked a lot about capital protection insurance as one of factors that parties look at. So if you can maybe give us a bit more details on how it's structured, what are the options, and what is the payout risk actually?
Sure. So to give an unhelpful answer, capital protection insurance is insurance to protect your capital, which I think the overarching point to make about it is, there is no market standard. At this sort of level, everything is bespoke. There's no sort of off-the-shelf, one-size-fits-all, and as a result, there are many, many options. So you could insure a transaction on a primary basis. You could insure a secondary transaction. You could do a hybrid, part primary, part secondary. Then you look at what's in the portfolio. You could theoretically do a single case on a CPI basis, but realistically you're going to be doing portfolios. You can insure at the fund on the manager level, in which case all of your investors benefit, or you could tailor it so it's done at the investor level, which gives you options if you have different investors with sort of different risk appetites and tolerances. You can insure the entirety of the fund, or you could do a percentage of it. You would obviously look at what do you actually want to be insured. So obviously capital that is actually deployed into cases, you're always going to want to insure that, but then you'd look at things like management fees, the premium for the insurance itself, and even upside. We are getting some requests from people saying, well, can you insure upside, which is sort of a whole discussion in its own right. As we'll probably touch on more, what is quite interesting with this as well is that you can include a duration hedge. So, with an adverse cost insurance policy, it's only going to pay out, well, other than interim claims, it's only going to pay out at the end of the case. But with CPI, you could say, okay, well, if the fund is underwater at year X, even though the fund is not wound down, you can make a claim on the policy, which essentially allows you to sort of stem the bleeding with your investors, and then you assign or sort of pledge future proceeds to the insurer until it's made whole again. So, in that way, you can manage duration risk. Obviously, we would rather just do it on a natural runoff basis, but it is, an option. I guess the point to be made is, adverse cost insurance is driven, when you think about it, by defendants, and it's mandated by the courts. So you don't really have much sort of wriggle room. If you want to do a case in England and Wales, realistically, you're going to need adverse cost insurance. But CPI is a completely different proposition because it's being driven by policyholders themselves. It's not strictly necessary. It does mean that it has near limitless options in terms of what can be achieved. If you're sort of to move on to the pricing of it, I know that's very juicy topic of conversation. Again, somewhat unhelpfully, it's kind of how long is a piece of string, because it depends exactly on what your CPI policy is going to cover. If you had, a single investment in your CPI, then that's obviously going to be very, very expensive. But if you have a mature, sort of well-diversified portfolio, then that's obviously going to be significantly cheaper. And probably goes without saying, but CPI is aimed at that end of the market. It's wrapping entire portfolios rather than trying to be a substitute for single case funding, which obviously is the domain of litigation funders. Generally speaking, though, we see a sort of staged deposit model, and that could be tied to time, or it could be tied to deployment in percentage terms. And then you might see what we call a sort of success premium, which is an additional premium on the back end that is calculated with reference to the performance of the fund itself. So it's, again, trying to foster risk alignment there. But I mean, we could talk all day about CPI, there's lots to go into, but I think that's a sort of, an overview, if you like.
Thank you. And sort of, if you compare what market share or insurance share of CPI within your law firm or within the insurance market when parties take the CPI as opposed to all sort of other instruments?
I think that adverse cost is certainly the much larger constituent part of the market. I mean, as sort of alluded to, you can't really get anywhere with litigation in England without it. That is the overwhelming majority of our book, but we are seeing an increasingly large demand for CPI. And I guess what's interesting is, let's say you want a £20 million limit on one cat case. Well, that's quite a big single limit, but it's nothing compared to a 200 million limit on a fund. So actually, it doesn't take that many requests before your book begins to fill up quite quickly with CPI. I think we'll get on to later some of the requests we see, but I see the market going this way. I think it's quite an attractive product. Obviously, I'm obliged to say that, but but it is growing as a percentage for sure.
Definitely. And Gian, in your experience when raising funds, what was your experience with the insurance and with getting this product?
Sure. I mean, so at Augusta and at Omni, in my prior role as CIO at Augusta, I worked quite closely with Nick. Spent a lot of hours on the phone because one of our funds that we raised was actually wrapped. And I think my feedback to the market, I guess, or from that experience, is that we expected the capital raise to be quite easy because it was wrapped. And it turned out that the investor base that we had and that we had relationships with actually weren't interested in the wrap. They felt that the downside in a portfolio of diverse assets really wasn't there to pay for that wrap. However, we then found a whole other world of LPs, primarily family offices, that were interested in the upside downside. But the biggest attraction I actually see to the product that I worked on with Nick, and also that we have in place, we've seen in place in others, is that duration hedge. That's probably the most valuable thing to me, and if I could structure it again, I actually would have done it only with the duration hedge if there's a way to do that. So the other point I would say is there are still questions from investors that we get about, will the policy pay out? I'm less concerned about policy paying out on a CIP, let's say a fund wrap, than something perhaps more bespoke, single deal oriented. But I would say the biggest caveat and the biggest advice I would give to people who are thinking about doing it is you have to adhere to the minutia of the document you've signed with Nick or somebody else. If you miss a reporting date, if you don't provide a piece of paper, you just open yourself up to an exclusion, and you owe to your LPs not to do. So just keep that in mind when you're negotiating these pieces of paper and you're structuring these. And don't take for granted that your investors will want them. You should sound that out first before you wrap the whole thing.
So did you feel that payout risk was sort of great?
Well, I mean, I think if you think about it from a trade perspective, if you're saying to yourself, I have no downside and an upside of a 20% IRR, okay, that's great, but but another investor may say, well, I actually don't think that the downside is there anyway because you're a good investor and you make a portfolio and I'm just paying 8 points of IRR away. But that's up to the investor, right? And it's also, I think Nick may mention this now or later, it's certain investors just are new to the asset class and they don't know if you're a good investor. So they provide you that safety blanket. So I think it really depends on the situation and ultimately the capital provider.
Thank you. Jiamie, I wanted to ask you to talk about your experience raising funds in the current market and the relevant challenges that you encountered both on the funding side, I guess, and insurance is relevant.
Yeah, well, I guess if you're choosing a time to do it, you don't choose a year bookended by a Supreme Court hearing and a Bugsby case if I did it again. Because the nature of the Supreme Court hearing from February onwards last year was one that was likely to cause uncertainty in the market. We looked at CPI at an early stage, but we decided early on that actually the portfolio diversification itself was going to be essentially that. Whether we were going to be right about that or not, and whether I'll be coming to you, Nick, in a few months' time saying I made a mistake there, we'll see. But in a sense, the decisions that I've taken in relation to, and you're quite right, Elena, to point out that it's not just the cases that you've funded that are important in a track record, it's the cases that you decided not to fund. And when I was scrabbling around at the beginning of the process to try and demonstrate track record, that was a very relevant criteria that I used, because it's an exercise of judgment ultimately that you're seeking to display. And my decision, and I'm fortunate that I got involved very early on with the partner that we've ended up with. It was, again, to take your point, Jan, I didn't want to have a different collection of diverse people who had different understandings and different requests and different requirements. And it's a trust and confidence relationship that is reciprocal, and you want to build upon it over time. One of the challenges, of course, I had was to try and get hold of Nick in August, but we did manage that. So to that extent, it was every litigation funding case is difficult. I mean, nobody who tells you otherwise, I think, is being accurate. There's always issues, and you just have to be honest and transparent, and therefore, to that extent, you have to be realistic early on in the expectations that you are giving to your investors. You can't sugarcoat it because they are in it for the long term. There are going to be, as Susan described it, there are going to be bumps in the road. As Neil described it, this is a political thing. 5 years, 10 years ago, investors were quiet in the shadows. You didn't really think that with litigation funding there was going to be too much risk. Now it's all in the open. Funding agreements are being looked at all the time. You're on the mainstream news. There are television programs, inquiries. It's a very different world. And you just have to be upfront and realistic about that and work with people that are going to be with you for the long term.
Thank you. And what were main questions from investors, the main requirements, what they wanted to see?
I think the flip side to the uncorrelated asset class is the fact that on the one hand you're offering 2-3x returns, on the other hand it's nothing. And how do you educate a market about that who is not familiar with the market? And you just have to set and manage expectations at an early stage and demonstrate such that you can, and the market is transparent to a degree that you can pick up and glean things from the public company statements and so forth. And so you just need to demonstrate that you've got credibility in what you're saying. And if you try and be too optimistic about it, you're onto a hiding to nothing, really, because you just have to accept and be humble in what you're seeking and what you're able to deliver.
Thank you. So just to follow up on this, Jiamie and Rebecca, from a multi-strategy perspective, how do you value litigation assets? Because different firms use different metrics. Is there one approach that you're comfortable with and use internally?
Go ahead. Yeah, like I think valuation, and I spoke to Eleanor about this before as well. It's something that's firm specific. If we're looking at an investment and somebody else has already done an underwrite, or potentially it's a secondary you're looking to invest in, sometimes you'll be able to see other people's view on value and how they've priced something. But ultimately, I think it's every firm takes their own approach, and it depends very much as well on the case in question. As a multi-strat, we're very much motivated by our returns. So everything is driven back to how do we see our returns moving in different scenarios. And ultimately, duration, therefore, as we talked about before, plays a lot into that. And so we don't have one specific sort of valuation tool or technique, which is the way that we price our risk. It's always very much case dependent, and in part for us, that's because of the diversity of claims that we look at. We don't just do UK cases, we don't just do CAT cases, we don't just do, you name it, Spanish antitrust. And therefore it's always going to be dependent on where a claim or case is as part of that process, and how we're looking at our recovery as part of that. My view, and Jiamie may share or disagree, is that I don't think there's a standardized approach in the market. In some respects you could say maybe over time that would be the case. But I think if that was the case, and you got a more standardized approach to valuation that you may see, for example, in the credit markets. Credit markets have a very standardized approach, standard metrics. People are able to, compare different corporates, at ease, and it enables a secondary market. That's not really existent in claims at present. Maybe that will happen later down the line and improve the ability to have secondary trading, in a more efficient or kind of quicker forum. But for the time being, we're very much King Street specific as to how we look at opportunity and how we value that and price it accordingly.
Yeah, I think you're absolutely right. It's very much an individualized approach per opportunity on how we value, the potential upside here. And it's not necessarily just, a formula where we plug something in and there's a number that comes out at the end. And I would imagine most funders, not just multi-strats, but funders in general sort of take that approach. And I mean, taking a step back, like in terms of using some sort of formula to value assets or standardizing the valuation of litigation funding collateral, it seems to sort of drive the trend toward further collateralization, further commoditization, which maybe in a maturing market it becomes inevitable at some point. But I mean, speaking from my personal view, if we're going to try to start standardizing further the valuation of really qualitative collateral, in a way, doesn't that sort of like impinge on the secret sauce of funders? Like, isn't sort of the unique underwriting approach, the unique sort of commercial judgment that we're exercising to put a value or range of values on certain collateral, isn't that like part of, what distinguishes one funder from the next? And would it be advantageous to the industry to start standardizing that? I don't know. As for our secondary market, it's not really common for us to sell down our positions. Opportunities to purchase existing positions, certainly they come our way, and we do take a look at them if they seem interesting enough. And if there is, an existing valuation analysis that's been done on the collateral previously, sure, we'll absolutely look at it and take it into consideration as a data point. But to the extent that it converges or diverges with how we look at it, again, that's a very sort of opportunity-specific inquiry.
I think from our point of view on this, we look at it slightly differently, because the price being paid to acquire the assets in question, it's not particularly relevant for us. What's relevant is what is the value of the collateral that sort of sits behind that. So if you're spending 100 million to buy a portfolio that's worth, $1 billion, then that's a far better position than spending 100 on a 200 portfolio, whatever it is. So it's, from an insurance perspective, I think it's all about the collateral value itself rather than the price paid.
If I may, I think this raises an interesting point. Like, all loops back to capital raising that Jiamie just went through. At the end of the day, LPs they want to see cash out for the cash in, right? And that's what we're, frankly, as an industry, not doing that great at, because it's taking a really long time. And I think when we're talking about valuation, cash is king, really. And I agree that saying, okay, it's only the cash basis that you've invested in isn't totally helpful. But it's the most objective thing we have. Right. So Omni came out, I think, at the last earnings report to discuss how we think about fair value, that being the probability-weighted net present value of all the cash flows in every case. So every case that we look at when I'm deciding whether or not to invest in something, we do probability trees and analyses of what the different risk points are, right? That's all helpful, but it's totally subjective, right? I may hand that to you, Nick, or to either of you to say this is what I think the case is worth, but I think if you're underwriting me as a partner in a protection policy, you're trusting me for that. But I think from a foreign investor looking into my fund, they say, that's wonderful, but I'm going to go through every single one of your models and see if I agree.
Yeah, I mean, the trouble is the case is worth nothing until the judge gives his judgment, and even then it's worth nothing until you've collected it. I've seen a number of these decision trees along the way, and I looked at one only the other day, which I said I wouldn't fund, and their percentage tree said it was great. So, I mean, you're absolutely right. It's so subjective. And you just have to, and the duration risk is just as you say about. I mean, a budget that you see on day one, and one of the reasons we want to get litigation people and finance people together in the investment committee at an early stage is that budget's going to change. Yeah. And that the judge sitting in his or her ivory tower is going to make an order that suddenly means £1 million extra is being pursued. And we've got absolutely no control over that, even if you control the litigation by the purse strings. You can't control that. And so all these gut instinct things, I think you have to have that overview. Yeah. And getting too into the weeds is naturally going to go, you're going to go on the wrong way on your tree. Yeah. That's my way of not doing a tree.
No, but I think you hit the nail on the head on, we always take a similar approach of you always need to be thinking very early on and balancing the financial view versus the legal view. It's the blended view together which gives you the gut at the start, whether it's something you should be spending.
And we all know a good legal case, a good case for lawyers is not a good case for funders.
Exactly that.
And that's this difficult, hard sell.
Agreed.
Doesn't really get you anywhere on the valuation question. Sorry.
It's up here.
Yeah. So when you were fundraising, sort of, what was the most difficult in valuation? Because you're sort of at the beginning of the process.
I think the difficulty is this reality that you can't value anything until the end, and what you say at the beginning could be entirely different at the end, and therefore the disjunct point between how your budget is always going to go up. I mean, there's never any. The cost surprise in a case is never the lawyer's never going to turn around and say, you know what, we've managed to get a saving here. It's only going to be 50%. And that goes up, and almost for sure that the quantum analysis is going to go down. And therefore, that's being honest at the outset, I think, is the challenge, because you've got to be trusting the people you're partnering with that they will accept that. And they are not expecting, the earth. And these, the cat environment, of course, has allowed, in a sense, the industry is basically underwritten the cat. If it weren't for litigation funders, the cat wouldn't exist. But because of that, and because of the fact that all the cases are going through appeals along the way, it's been very difficult for anybody to see actually where is this going to end up. We will find out, in a few weeks' time with BT. But because of that uncertainty, that the valuation is just another facet of that. That is another extra risk that you've got to put in at the beginning of your analysis.
I think I'd sort of agree entirely with what's just been said. I mean, if you by way of analogy, if you bought a building that was built and there was a 50% chance that in 3 years' time it would immediately be turned to ashes, you wouldn't pay
or a wonky pub.
Precisely, you wouldn't be paying whatever the market rate is. You'd be wanting a steep discount on that. But a lot of money changes hands on the basis that this is a 3x asset, and as Jiamie's already said, it's actually a nil asset until judgment, appeals, enforcement is all out the way. Only then is there any real value to be seized upon.
I think I agree on an individual case basis. I think then when you bring statistics into the picture, which is the frank picture, I think the truth of the matter is, I think you allude to it, Jiamie, we're kind of all along for the ride on these individual cases, but if you do 100 cases or 200 in a portfolio, you're really talking statistics. And I think that and I apologize if I'm jumping around, but you were talking about capital raising, I guess lessons from that. And having done that for Augusta, now with Omni, we're raising funds 4 and 5, Series 2, so complicated, but the next one. And I think the biggest pushback we've actually had from LPs in general, now in both experiences, not just Omni, is not just valuation and not just duration, but just us as a product, right? We are, duration's an unknown. These IRR numbers that we've pitched everyone are great, but where's the cash? It's kind of a universal thing, and in that environment, I really commend you, Jiamie, on raising your money, because I think it's very tough right now. I think what it highlights is that we need to all realize that we are an asset management business and not a case management business, and probably need to improve our product, right, as an industry, but also as funders, to think about how we're not going to be talking about valuation now, next time, but how we're going to be thinking about how well the last fundraise went.
Yeah, it's definitely about managing expectations, isn't it? I mean, I think a few years ago people were assuming that this litigation funding business was a sort of John Grisham novel in the making, and everybody was going to be going off with private jets after a couple of big wins. And the reality is that the industry has seen that there haven't been huge wins in that sense, but what there have been is quite a lot of big losses. And that's got people edgy, and the diversification of the portfolio isn't as straightforward as you think, and the deployment pressure means that everybody's piling in to cases that promise the earth, but they cost the earth, and everybody's just trying to find their way through that, and I think investors have to be managed carefully, and the education still, I mean, that's why I think, Nick, you were saying in insurance, there's so much education still to be done to the industry. And we do need to do that.
Yeah, I'd agree with that. I think, look, from our perspective, what we see LPs and investors, of our products focused around is, exactly that. But they're not experts in what we do, what litigation funders do, kind of across the market. So they're very much relying on us to be able to pick the right cases, to pick the right opportunity sets. So
and they're a bit sceptical.
Absolutely sceptical. And so as a result, the focus is just always around, are we the right people to underwrite this? Do we get their trust and confidence in what we can do and what we can deliver, and therefore where is our track record? Track record is just absolutely critical.
It's almost the same as the asset of going out to market to get money is almost like due diligencing a case, isn't it? You have to go through the same process, and the same issues are relevant, and often the results are the same.
Thank you. Just to sort of maybe follow on what Jiamie said on secondary market and just cover this final point. So do you think maybe are you seeing this trend that co-funding or syndication is one of the ways we can mitigate all those risks that we have discussed? Is the secondary market developing vis-a-vis the last few years? Chen, maybe?
I think Omni's been in the market in the past are known for having done secondaries pretty publicly, and there's been others that have traded. I think I'm still, skeptical because they're still highly complex, very bespoke. I think a lot of secondary buyers don't want to pay management fees, and they forget that they're taking, let's say, a third of the deployed capital away from the manager, therefore their fees on deployed go down pro rata, and are still expected to manage the whole thing. So I think that we will gradually start to see an improvement in that, but it's not necessarily a panacea to what we do. I think we as funders, whether you're King Street or D. Shaw or Omni or Jiamie, need to think more as we build the product, as we make our investments, how that impacts the fund we have for our LPs. And secondary is a good way to manage duration actively. As asset managers, we should do that. I don't necessarily think they're a panacea. I also think that you're also, when you're doing a secondary, you're making a bet that the manager that you're buying from, particularly if you're doing a minority or even majority stake and they still service, are going to be around, right? So it's kind of when we, in the law firm loan discussion earlier, you're making a credit bet. Here you're making a bet that that manager is going to be around. And I think until there is a solution to that through third-party services or other, you're always going to have the question mark and dependability on the actual operations of the manager.
See, I find the lack of sort of syndication and litigation funding quite interesting. We sort of heard, just now and earlier today that, people saying, oh, it can't really be done, or I don't really want to do it. But, in adverse cost insurance, syndication is routine. You'd expect to see sort of 2 to 5 insurers on a big deal, and it's not that complex. You can sort of work together to common standards. You can have a broker kind of herd the cats. It's all achievable, and sort of syndicated commercial finance is everywhere. I mean, I read ages ago something like 100 different banks clubbed together to get the Channel Tunnel built, and I kind of think, well, if you can do that, then surely you can co-fund. But it seems like there is.
Yeah, co-funding, I think, is easier than a secondary on an existing fund. Like let's say trying to solve a duration issue on a fund that was supposed to end in year 6, it's now in year 8. You're trying to cut it off and sell, right? Then you're either going to have adverse selection accusations, or you're going to have arguments about the price. Oh, but I have these 6 cases, they're going to make me $1 billion, and the guy's like, well, I'm going to pay you 1.5x. Great, so you're going to have that. But I think I agree with you on the co-fund part. We're certainly seeing
it's at what stage the co-funding starts, isn't it? Because the sequential co-funding, the flip side for basically taking away 3 years of your expense because you're coming in a few months before trial. Is flipped over to saying, well, is it last money in, should get a better return on, but potentially not always, because actually you are saving yourself that big duration risk, which as we've said is so significant. So it will be interesting to see.
It sounds to me like the panel needs to buy some CPI with duration hedges built in.
Just the duration hedge, please. Just the duration.
If you could hand it out afterwards, we'll pick it up.
So thank you. Any questions from the floor to the panel? I can't see you. Okay, well, thank you very much. That was very